Welcome to the Daily Stock Review. The goal of these channels is to uncover the world's best stocks that have 100x potential. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years. I'm sharing the lessons along the way. Today we're going to be doing a valuation of Nvidia using 8 different methods, including a DCF, which is a discounted cash flow. And that's going to be to work out the intrinsic value of the stock. So here's the investing process. It's got 5 steps that I use: where to look, do a 5-minute check, do our homework, and do the valuation in step 4. So that's what we'll be doing today. I've learned from these guys over the years. They've done pretty well for themselves, and by following the breadcrumbs that they've left, we should be able to follow in their footsteps. So let's jump straight in. So method 1 is price to sales. So really what we want to do here is just pretty much grab the total revenue and the common shares outstanding. And so where do we get these numbers from though? So from our income statement, and in either for the common shares, we can find them in the annual report, which we can use the find function on the PDF, or we can just Google it and get the AI summary. But we also want to sanity check it at some stage. So let's have a look around for what we do for this one. So income statement, I've literally just typed in Nvidia annual report, clicked on 2026, got the latest one, and I want to find the income statement. We've got our cash flows, we've got our balance sheet, and our income statement. So we want to find our revenue, which is here, so 215,938. And it's in millions. So 215,938, and then with millions, we've just got to add 6 zeros after it. And so we add that in. We've got our common shares outstanding. Like I said, just type it into Google and ask Nvidia common shares outstanding. And all our earnings per share does is it grabs total revenue divided by common shares outstanding. And we get $8.92. Now, our current share price is $196. So what does this mean? So what we do is we just get a multiple of it. So we do 196, the current share price, divided by the earnings per share. And what we do is we get 22. So that just means multiple shareholders are willing to pay 22 times the the sales per share. Now we try our next method, number 2. So earnings per share. So we have the net income now. That's a different figure. And then we have preferred dividends, which may need to come out, divided by our common shares outstanding. Where do we get these numbers? We've got the income statement for these two, and then we've still got this same common shares outstanding here. So let's have a look. It's on the income statement. So jump back over here. The net income is usually at the bottom of the income statement. So we come down here. In 2026, the latest year, we've got 120,067. And it's in millions. So again, we type that in, put the 6 zeros. Our preferred dividends, there's 0. So that's just 0. Divided by our common shares outstanding, and we get $4.96. Just like before, what does that mean? Well, we've got a current share price. And by dividing the current share price by the earnings per share, you get a multiple of about 40. So shareholders are willing to pay 40 times that, the earnings per share. Method 3, book value. So we calculate that by the total equity minus the preferred equity divided by common shares outstanding. So this is price to book, or book value per share, BVPS. And so we want to look for this total equity and then preferred equity. Both of those are on the balance sheet. And then we want to look for common shares outstanding. So we've already grabbed that number earlier. So total equity, we want to find the balance sheet. Here we are. And usually scroll down because equity is just assets minus liabilities equals our equity. And we've got total shareholders equity 157,293, and that's in millions as well. 157,293, and then our 6 zeros following it. And then we get $6.49. What does that mean? The shareholders are willing to pay a 30 times multiple. Now we've got our PEG ratio. So this is one that was popularized by Peter Lynch. So price to earnings to growth. So our current share price divided by earnings per share, and then we grab the earnings growth rate and divide it by that. So we've got 196. We've already calculated our earnings per share, which was $4.96. And all our earnings is our net income. Now what we want to do is we want to look at this income statement, and let's just grab either 2 or 3 years. The more the better. But for this, let's just have a look at the last 3. So where did I grab those numbers from? Our income statement down at the bottom. So we've got our 2024 was $29 billion. 25 was 72 billion, and 120 billion in 2026. So grab these numbers, put them in here for each of those years. And from going from this year, 2 years ago to last year, it was 145% increase, which is absolutely crazy. And then from 2025 to 2026, the net income has increased 65%, which is still crazy. So now we grab our earnings growth rate. Really, we can pick one of these numbers, which one either looks like it's the most likely at the current time, and which one's kind of, I guess, the trend over that period. Because Nvidia has pretty much jumped up and then is now coming back down, let's just pick 65 for the sake of it. So we can see that our PEG ratio, which is just 196 divided by 496 divided by 65. So we end up with 61 or 0.61. So what does that mean? So if it's less than 1, it's potentially below value considering the growth. If it's more than 1, it's potentially overvalued considering growth. So over time, if our business, Nvidia, its growth rate normalizes back down to, say, 10%, and we punch that figure in, we actually have a PEG ratio of almost 4. So we can see that the people at the moment that have bought into the stock and are holding that, are influencing the price of it, they do believe that longer term, the business will do better than 10%. All right, so our next method, number 4, if I'm aware, net working capital per share. So we want to grab our current assets minus our total liabilities divided by common shares. Where are we going to find these figures? On the balance sheet. So we grab our current assets, we've got current assets, and then we get our total current, so 125,605, and then we grab total liabilities, 49,510, and these are in millions. Punch those figures in. We've already grabbed our common shares outstanding already. We get $3.14. So similar again. This is more of a bankruptcy and liquidation valuation. which just means if this business was very undervalued and it was close to being bankrupt, we want to have an estimate for how many dollars per share is the business still holding if it was able to sell all its assets. We're actually going to keep any money at the end of the day if the worst case happens. All right. Method 5, we've got method 6, sorry. Free cash flow. Let's count it out. 1, 2, 3, 4, 5, 6. There we go. So free cash flow per share. Now what we want to do is we want to grab our operating cash flow minus our capital expenditures divided by common shares. So where are we going to grab these numbers? So on the cash flow statement. So we'll jump back in. Literally just going to scroll down. We're going to see our cash flow statement. We've got our net income here. And then we've got net cash provided by operating activities. Pardon me, this is the number that we want. So we grab that one. And then what we're going to do is minus we want to find property and equipment, something around those kind of terms that they're using. It says purchases related to property and equipment and intangible assets. So we grab that number there. Punch that in. Make sure we add our zeros in. Divide it by that. And we get $3.99. Our current share price is that. We get a multiple of 49. So as we get further and further down in terms of diving deeper into the financial reports, the cash flow of the business is usually a little bit lumpier, but it's also the more accurate measure over time. Now, number 7, owner's cash per share. So one that Warren Buffett has utilized back in the day was owner earnings. And this was before we had the cash flow statements included in most annual reports. So back in 1986, in one of his annual reports, he placed a calculation for what owner's earnings was. And it was really just him going through an income statement and trying to normalize what was the actual cash flow at the end of the day. And that value ended up coming out as pretty close to the operating cash flow. And then what he did was he'd subtract the ongoing capital expenditure. Now, one that we do want to do as well is, in terms of what I'm looking at, is the operating cash flow minus moat maintenance. So what are the actual costs this business needs to put in just to maintain their moat, which is just their competitive advantage. So things like plant and equipment, they might invest in those to grow the business, but what's the actual figure that they need to just maintain their equipment and maintain their current rate? So it's usually a bit less, and there's a little bit of a difference between repair and maintenance costs and then what our capital expenditure is to either grow the business. So what we do is grab our operating cash flow. We've already seen where we grab that, and moat maintenance. So for this example, we'll just keep it simple. We go into the cash flow statement, but we can also go through the notes to financial statements. And what we want to do is have a look through there, as well as the annual report if it has any extra details, just to see if there's any breakdown of what repair and maintenance is versus growth for the business. So usually they'll have a couple of projects and things like that. All we do then is we should come up with a figure which is usually less than what's on the cash flow statement for the, what do we have? For the capital expenditures. And then we also had our common shares. For this scenario, because we haven't adjusted that, we get $3.99. And so sometimes as well, by just using free cash flow, as it had up here, it's only taking out the capital expenditures, which is usually, and property, plant and equipment, if we're being specific. but we can also include intangible assets that certain businesses need to build because they're building software-based assets instead of physical assets, so things that we can touch. So we need to keep that in mind to include things like that. All right, so that is number 7. So what does all this mean? So these are all relative valuation methods. So all we do is we grab these numbers and these multiples, and then we compare it with its competitors and other industry kind of benchmarks. Similar with the PEG ratio. PEG ratio, we just want to have a look at, is it potentially undervalued? Is it something to have a look into further? Now, these aren't just things to jump straight into and buy a stock. They're more indicators to have a closer look if there's something going on. But these are 7 methods to get there. Now we want to have a look through what's our intrinsic method. How can we actually see if something's like intrinsically below or above its value? So first of all, we want to know, why do we actually perform fundamental analysis? And so all that is pretty much when we get an annual report, technical analysis is just going through and having a look at the stock price and as it fluctuates and inferring something that the price is going to do next. What we want to have a look at is the actual business itself and understand it. So reading through the annual report, understanding the management team and things like that. So I use a checklist, run through and ask myself questions and things like that. So big picture, mastery, there's competency. So do I have competency around it? Do I understand the business? Next is the business consistent? Is the business continuing relatively unchanged? And so what we would want to really ask is, will my inferences, so what I think will happen about the future of the business, is it going to have a medium to high level of certainty? So if this business is fluctuating wildly and it's completely erratic, they're doing different things, they haven't set their certain business, the answer is no. And it's going to be incredibly difficult to get some form of even directionally right value for the business. Next is moat. So we want to have an understanding, is this business have a good competitive advantage around it? So we can pick out what kind of moat is around the business, what evidence is there for it, what are their competitors doing, their adversaries, and then a test. So having a look at how is that business going to compare when times get hard. And so what we really want to answer is, will my business still be great 20 years from now? Now, if it's not, it's very hard to value a business because this valuation method fast forwards to pretty much the end of time. So we need to have a pretty good understanding that it's going to be a great business. Needs to have good pricing power. Now, the last one is management. So management at the end of the day can destroy a great business. We want to make sure that they're a good management team, and there are ways to be able to assess that. So a bunch of smaller questions that round up to, is management candid? Things like, is the founder in the management team? So founder-led businesses, they look after it like it's their baby. Think of Jeff Bezos and other great founders like that. So is management aligned with long-term shareholders? They're looking after it like it's their baby and their child. They are very aligned with long-term shareholders. And rational, so some tests to see if they're being rational over time. So the big picture is, would I entrust management with my business? Now, with those bits and pieces, we can actually decide if a business is worth valuing. If it's not, then we shouldn't even bother with any of this. Because at the end of the day, Warren Buffett and Charlie Munger talk about people spending too much time in spreadsheets. The whole point of me using this one now to show you guys is because it's easy to visually see where everything's plugged in and how you guys can calculate it. Now, why do we actually perform all that effort into fundamental analysis? For growth probabilities. That's what we want to see. We want to think about what are the potential outcomes that this business is going to go through. And so what's really key here is over the next 10 years, and then what is it going to do after that? So things like what happens if AI goes to, AI collapses and it's the end of the world. Well, any end of the world scenarios means that we shouldn't invest anything and we should throw our hands up above our head and start screaming. That's not really an option that works. And one that Howard Marks mentioned was that during the 2007-2008 global financial crisis, if they thought that, their idea was we may as well not be doing our job if we weren't investing. So the only option for them was to eliminate that scenario from their thought process, because if the world ends, nothing really matters anyway. So assume that it doesn't, but what happens if there's zero growth? Or what happens if there's negative growth and the business goes back to a previous steady state? What happens if the business just goes at 10% growth for the next 10 years? And so we kind of get a bit of a picture around what the growth of the business is. And so I've just plugged in some arbitrary numbers here. If it's a small growing business, we might be closer here and be closer to things like 2.5%, 5%, 7.5%, 10%, as opposed to, Nvidia, which is growing at 65% in the last 12 months. But what do I think it's going to do over the next 10 years? And for me, just arbitrarily here, I think that the most likely thing is it's going to grow at about 10%. And we're trying to think conservative. So once we come up with this and we come up with what risks there are within the business, we then want to come up and plug it in. So let's go through what the discount cash flow method or model is. So Nvidia, it's on the NASDAQ. Now, what it uses is the base year free cash flow. What the hell is that? So previously we got our free cash flow and we grabbed that from using the operating cash flow minus the capital expenditure. Now I've just got those totaled up for the last couple of years so that we can have a bit of a play and see what those values are. Then we then got the number of shares outstanding, and then we've got our current price per share. Now, what we do is plug in the 10% growth rate. That's what we think that this business will be going for or in growing at over the next 10 years. Years of growth, I've just set it up so you can adjust those. Set it for 10 for the time being. And then we've got our discount rate. So our discount rate it varies depending on who's doing the valuation, what business is being valued, and things like that. Some people use the weighted average cost of capital, so WACC. Warren Buffett uses kind of the risk-free rate, which he usually refers to as T-bills, so whatever percentage they're returning. But he also says that, and Charlie's said during interviews, that he's never actually seen Warren Buffett do a discounted cash flow calculation. So what he uses roughly how this calculation kind of works, what it takes into account about discounting future cash back to today, and then comes up with an estimate. He doesn't sit in a spreadsheet like this or use a calculator like this. He's more back of the envelope, gets it fairly close, and then goes from there. Now, I've used a discount rate of 6% because for me, if a individual investor like myself can just put money into an index fund, get 6-8% a year on average over the next 20 to 30, 40 years, that's pretty much the risk-free rate, if we're being honest. Next for me is the growth rate to perpetuity. So what this one means is it is just what's the rate at which this business will grow every year after that 10-year period. So my estimate for that and how I come up with 3 is do I think this business can continue to raise its prices in line with at least inflation? And I think it could, because it is a great business. It's founder run. Is Jensen Huang going to be there in another 10 years? Don't know. But he's a pretty cluey guy. I think he'd be able to install a really good management team in his place. And the business would continue to grow at least 3% after that. So this calculation calculates that each year for the 10 years. It then discounts that value. So in 10 years' time, the business will have grown to about 250. What do we got? Free cash flow, will have grown to 250 billion. But we then use that 6% discount back to today. And today, that money is only worth $140 billion, because as time goes on, money diminishes in value at that discount rate for us. So they get totaled in. We then get the perpetuity totaled in as well. We get an intrinsic value. We then get our intrinsic value per share. And what that means is that's how many dollars that this calculation with these figures for growth rates, etc., values the business at. So $255 per share. Now, we get a margin of safety. So because our current stock price is 196, it's less than our 255. So we get a 77 cents paid for $1 of value. So if we buy this in the market, what this value here is telling us is we're getting it below value and at a 23% discount. So that's interesting. Now, what would happen if this business didn't grow at all and it had a growth rate of 0? Well, the intrinsic value of the business would be worth $133, and that would mean that we've overpaid for the business and at a 47% overvalue. Now, this calculation is extremely sensitive to these growth rates, and that's why it's better to be directionally correct and close to the money as opposed to being completely way off. So let's have a look. For instance, if over this next 10-year period, this base year free cash flow changed and it didn't just go to 2025 or 2026's value, it actually went back to the previous year and went back to a more normalized rate after the hump through the AI bubble, we would have a valuation of $160. That would mean that we'd overspent $22 compared to the current share price. Now, what about if it really went backwards and we had a 10% growth rate, but from its previous 2 years previous? So we can plug that in. H. And we can see that the business would be valued at $71 a share, and we'd overpaid 175%. So nearly, almost over double the price to what it should be. Now, what does this mean? So what can happen is we can buy at this share price, and if this value and the growth rate doesn't catch up, it could take a decade or more for us to reach that original share price again. Or the business might not actually grow over that time. It might slow and start to decay, and we don't get the opportunity to reach where we thought the stock was going to grow to. So what this margin of safety is here for is to make sure that in our assumptions, if we've stuffed up big time or we've been not very conservative with how we've calculated it, we can then add that back in and ask, we can wait until the current stock price is less and we're happy with the amount of discount that we're going to get. All right, so that is our 8 methods for covering a discount or covering the valuation of Nvidia and how to calculate it. Now, if you guys like this stock valuation calculator, the investing checklist, or any other free resources, you can check out the link in the description. It's all free. It's a free community as well with other investors just like you guys in there learning as well. Here they are. It's also got a few other goodies as well, like when to sell and financial statements, some cheat sheets in there for you guys. So if you like that stuff, use the link in the description. And otherwise, I'll catch you guys in the next video and check out this one here. Cheers.